Hello and welcome back. In today's video, we will be taking a look at covered call ETFs, which are either based on the Nasdaq 100 index or are technology focused and compare them across different metrics. There is an important caveat that I need to mention upfront. Unlike the S&P 500 index, which has numerous dedicated covered call ETFs, the Nasdaq 100 index has a limited number of such ETFs, especially on the Canadian stock market. Hence, in this video, I'm going to use ETFs that are listed on the US stock market as well. In addition, there are going to be ETFs that are solely focused on the technology stocks within the Nasdaq index. So, this is not going to be exactly an apples to apples comparison, but given the fact that the vast majority of Nasdaq's returns come from its technology stocks, I would say this is a fairly even comparison. So, here are the ETFs I'll be comparing. As you can see, I'm comparing a total of 7 ETFs, two of which are trading on the US stock market. These are the Defiance Nasdaq 100 Enhanced Option Income ETF with ticker symbol QQQY and the GlobalX Nasdaq 100 Covered Call ETF with ticker symbol QYLD. I have grouped them alongside the GlobalX Nasdaq 100 Covered Call ETFs on the Canadian side with ticker symbol QQCL and QQCC. The only difference between them being that QQCL uses a 25% leverage while QQCC does not use any leverage. Together, these four ETFs are based entirely on the Nasdaq 100 index. In addition to these four ETFs, I will also be comparing three ETFs which primarily focus on the technology stocks within the Nasdaq 100 index. These are the Evolve Nasdaq Technology Enhanced Yield Fund with the ticker symbol QQQY, the Hamilton Technology Yield Maximizer ETF with the ticker symbol QMAX, and the CI Tech Giants Covered Call ETF with the ticker symbol TXF. All these ETFs focus on technology stocks while also generating covered call income. I think this will be an interesting comparison. As a side note, the ETFs from Defiance and Evolve have the same ticker symbol QQQY, so to differentiate between them, I will use the .to for Evolve ETF, which basically indicates that it is trading on the Toronto Stock Exchange. Now that we know what ETFs we will be comparing, let us take a look at the metrics we will be using to compare them. Like my previous video where I compared S&P 500 based covered call ETFs, I'll be using the same overall metrics to compare the Nasdaq 100 and technology based covered call ETFs. As you can see on the screen, these metrics are the covered call strategy, the distribution yield, the fund structure, and the total return. Within the covered call strategy, we will take a look at the moneyness, the portfolio allocation for covered call writing, and the leverage used. Within the distribution yield, we will take a look at the overall yield percentage, the frequency of distribution, as well as the consistency of the amounts distributed. Within the fund structure, we will take a look at the holdings type, which indicates whether the fund directly holds the underlying companies or uses other ETFs to track the returns. We will also compare the management expense ratios for each ETF, as well as how accurate each ETF is when it comes to tracking the Nasdaq 100 index. Last but not the least, we will take a look at the total return of each ETF to see if they actually manage to meet or even outperform the returns of the Nasdaq 100 index, and also to figure out which of them is the best value for giving us a high income while also providing a good capital return. In case you want to jump around these metrics, you will find the timestamps in the pinned comment. With all that highlighted, let's get started with the comparison. Within covered call strategy, we are looking at three factors: the moneyness, which tells us how much in the money or out of the money the options are written, the portfolio allocation, which tells us what percentage of the portfolio is allocated for covered call writing, and the leverage used, which tells us if the ETF is using any leverage. Starting with moneyness, we can see QQCC, QQCL, and QQQY from Evolve are the only ETFs which place an emphasis on capturing some capital gain even within their options. They're writing out of money options. These percentages may seem negligible, but given the fact that they are aiming to be high yield ETFs, this is the best we can hope for. In addition, these three ETFs also limit the portfolio allocation for covered call writing up to 50%. They also use a dynamic approach, which means that there are going to be times when the amount of portfolio allocated to covered call writing will be less than 50%. It just depends on the market conditions and how the management expects the underlying holdings to perform in the near future. But 50% is the upper limit. All other ETFs write at the money options, which means that they are giving up 100% of the upside for the portion of the portfolio on which options are written. QMAX and TXF stand out among the remaining ETFs because they are only allocating 30% and 25% of their respective portfolios for covered call writing. In other words, with QMAX, 70% of the portfolio, and with TXF, 75% of the portfolio will receive the benefit of capital upside from the underlying holdings, while the remaining portfolio provides option income. Last but not the least, we have QYLD and QQQY from Defiance, which are not only writing at the money options but also allocating 100% of their respective portfolios for option writing, which means that they are receiving maximum benefit from options writing but also giving up complete capital upside. Based on this information, we can draw three categories for these ETFs. The first category would be purely income focused ETFs. QQQY from Defiance and QYLD fit into this category. These ETFs do not mind sacrificing all of their capital gains potential to receive maximum income. The second category would be ETFs that provide a more balanced approach. QQCC, QQCL, and QQQY from Evolve belong to this category. They limit the portfolio allocation for options writing to 50% while also trying to capture some capital gains through their options writing. So these ETFs are aiming to capture the best of both worlds. As a side note, QQCL is the only ETF that uses leverage and is basically QQCC with the leverage added. Lastly, QMAX and TXF are more capital gains focused ETFs. By keeping their portfolio allocation for options writing to a minimum, they are trying to capture as much capital gains as possible, while at the same time providing higher income than some of the more traditional dividend stocks. Each of these three approaches impacts the final distribution yield for these ETFs, as we will see in the next section. The table on the screen shows the distribution yield for each ETF. QQQY from Defiance easily stands out with a whopping 80% yield. TXF, on the other hand, only has a yield of 7.82% and is the lowest yielding ETF on this list. It is also the only ETF which pays out quarterly as opposed to a monthly distribution schedule used by all the other ETFs. Some people may find that a bit problematic. However, in the long term, it balances out. It is important to note that TXF, along with QILD, is one of the first covered call ETFs. Both these ETFs have been around for over a decade, and later in the video, I will be making a 10 years comparison just between these two ETFs. The second column on this table basically shows you the consistency of the payout amounts for each ETF. The ETFs marked as consistent tend to pay out a relatively consistent amount on a month to month basis, which occasionally change every 4 to 6 months, depending on how the underlying holdings are performing. For example, if we look at the payouts of QQCL, we see that every month they are paying out 25 cents per share. In other words, I can be quite certain that my payout will be 25 cents per share for the next month. That is not the case with ETFs marked as inconsistent. If we look at the payouts from QILD, the amount paid out changes from one month to the next. And it is the same with TXF and QQQY from Defiance. Again, in the long term, it is not a major detriment, but some people might like to receive the consistent, predictable payout every month rather than a random number. But let us take a closer look at the yield percentages. Apart from QQQY and TXF, which stand out as the highest and the lowest yielding ETFs respectively, all other ETFs are paying out somewhere between 10 to 13% yield annually. On the surface, they might seem equally matched, but when we combine the yield percentages with the covered call writing strategies that we saw in the previous section, we realize that some ETFs are doing a better job than others. As we can see in this table, the amount of portfolio allocated for covered call writing directly impacts the yield generated. No wonder TXF has the lowest yield because it is also allocating the lowest amount of portfolio for covered call writing. In comparison, however, QMAX is doing a much better job. It too allocates only 30% of its portfolio for covered call writing, but it is generating 4% more yield than TXF. One thing we must not forget is that both TXF and QMAX are technology based ETFs and do not track the Nasdaq 100 index in its entirety. Hence, their higher return is mainly the result of them being concentrated in only technology stocks. The same is also true for QQQY from Evolve. On the other hand, QQCC, QQCL, QYLD, and QQQY from Defiance are actually based on the Nasdaq 100 index, and among them, QQQY is easily the highest yielding ETF at over 80% yield. But QQQY's aggressive approach also comes at the detriment of its net asset value, or NAV, which has seen a rapid decline since its inception. Later on, when we look at the total return, we will see that it is not the best strategy. Similarly, QILD's NAV has been in a decline since its inception, although at a much slower rate. It makes sense because QILD is paying out a more sustainable yield of around 12%, and a portion of its option income also gets reinvested in the fund every month. QQCC and QQCL, on the other hand, are capturing at least 50% of the upside for the underlying holdings and also providing annual distributions which are comparable with that of QYLD. This definitely makes them a better investment compared to QYLD because they are providing a similar yield, but at the same time, there is potential for capital growth. Also, if you're in Canada, you are better off investing in a Canadian listed ETF because the income received from QILD would be subjected to withholding tax. So you will end up receiving a lower income anyways. Additionally, if we compare them with technology focused ETFs such as QQQY from Evolve, QMAX, and TXF, we find that QQCL is outperforming all of them in terms of distribution yield and is also more diversified. Similarly, QQCC is only marginally behind QQQY from Evolve and QMAX, and ahead of TXF in terms of distribution yield. Overall, when it comes to maintaining a perfect balance between diversification of holdings, distribution yield, and capital upside, QQCC and QQCL seem to be excellent choices among these ETFs. Depending on whether you are comfortable with leverage or not, you might prefer one over the other. Now, let us take a look at the fund structure of these ETFs because how a fund is structured impacts the long term sustainability as well as specific risks associated with these funds. The way a fund is structured affects its management expense ratio, or MER, and also its long term returns. It also informs us what underlying risks a fund may have. In the table we see on the screen, the first column shows the holdings type. This lets us know whether the ETF is holding companies directly or using some other methods to track the returns. Only three ETFs on this table directly hold company stocks: TXF, QMAX, and QQQY from Evolve. In my opinion, this is the best type of holdings since it is the most cost effective and does not involve any additional risks other than the holdings themselves. QQCC holds the QQQX ETF, which is the Nasdaq 100 Index ETF, also from Global X, and it is this ETF which actually holds the companies. This results in a higher expense ratio since it is an ETF within an ETF structure. This is even worse in the case of QQCL, which holds QQCC and uses a 25% leverage. Thus, QQCL is using a triple layered ETF structure along with the leverage, which results in a significant management expense ratio at 2.33%, which is more than double that of the next most expensive ETF on this list, QQQY from Defiance at 0.99%. The higher expense ratio is compensated by a higher yield and also higher potential for capital gains, but it is worth noting that the leverage and a multi layered ETF structure comes with significantly higher expenses. Last but not the least, QQQY and QYLD have the most unique holding types. Let's begin with QQQY from Defiance. QQQY does not hold any stocks or ETFs. Instead, they simply hold US Treasury and bonds as collateral and write daily put options on the Nasdaq index. Depending on how the options perform, they make a profit or loss. This approach ends up being costlier than other options income ETFs, and also the aggressive options writing strategy means that the fund loses out on the majority of the capital upside for the Nasdaq index. Similarly, QYLD loses out on all of its capital upside, but there are a few things that they do differently. For starters, QYLD does write covered call options and it writes it on the Nasdaq 100 index itself. This makes it quite cost effective when compared to some of the other ETFs on this list, which write options on underlying stock holdings. It also does not use any leverage. No wonder it has the lowest management expense ratio on this list. Also, earlier we saw that QILD writes at the money covered call options and gives up all of the capital upside. However, it does preserve some of its fund value by not paying out all of its option income every month. Instead, it pays out only 1% of its total fund value every month, resulting in an annual yield of 12% approximately, and whatever is left over gets reinvested in the fund. This is a nice way to make sure the fund's value is preserved, although I would have preferred for it to simply use a less aggressive options writing strategy, where instead of writing at the money options every month, the management could actually use a dynamic approach and write out of money options occasionally whenever the market is expected to go up. Such an approach, in my opinion, would result in higher capital gains while still maintaining a similar yield percentage. Maybe it might also cost more in terms of expense ratio, but I'm willing to make the trade off for a better capital upside. The last column shows you which ETF does a good job at tracking the actual Nasdaq 100 index. In all, there are four ETFs which are actually based on the Nasdaq index, and the remaining three are more focused on the tech stocks within the Nasdaq index. Among these, the ones that really stand out are QMAX and TXF, which are really concentrated upon a few tech companies. This actually helps us understand the different approaches ETFs use to generate higher distribution. Some use an aggressive covered call writing strategy, while others simply choose to go with an aggressive set of holdings. Let us compare QQCC and QMAX ETFs as an example. If we look at their management expense ratio, it is almost identical. Nothing much to distinguish over there. If we look at their distribution yields, again, not a huge difference. They are within 1% of one another on an annual basis. Some might say QMAX so far has been marginally better, and I would agree with that. But let us now take a look at their options writing strategy. Again, QMAX outshines with a less aggressive strategy where it allocates only 30% of its portfolio for options writing, whereas QQCC is allocating up to 50%. Yes, QQCC does write out of money options, but that doesn't really offset the higher portfolio allocation. So, what is exactly going on here? QMAX is charging marginally lower expense ratio, paying marginally higher distribution, and also using a less aggressive covered call writing strategy than QQCC. All of this is possible because QMAX is using a very aggressive approach in terms of its holdings, just 15 tech stocks, as opposed to QQCC, which holds the entire Nasdaq index. Thus, QMAX has a more risky set of holdings, since the risk is spread out only across 15 companies. Simply looking at the distribution yields, one might think, well, these ETFs are almost identical in terms of the income they are paying out. But when we look deeper, we realize that one ETF is using a more aggressive covered call writing strategy to reach that distribution level, whereas the other is using a more aggressive set of holdings to reach the same distribution. Thus, the closer an ETF is to tracking the index, the less aggressive it is in terms of its holdings. So QQQY from Evolve is still more aggressive than QQCC, but less aggressive compared to QMAX or TXF. Now that we have a good understanding of how an ETF's fund structure impacts specific risks associated with that ETF, let us take a look at the last comparison metric, which is the most important consideration for any investor, the total return. When it comes to total return, it is important to make sure that the time period we are using is equal across all ETFs. Each ETF on this list has a different inception date, and depending on the market conditions when the fund started trading, their returns would get impacted. In other words, it would be unfair to compare the returns of a fund that started trading during the bearish period of early 2020 as opposed to a similar fund which started trading at the start of 2021 when the market sentiment was more bullish. To work around this problem, it is important to compare ETFs across a common time period. Hence, similar to my previous multi-ETF comparison video involving S&P 500 index-based ETFs, I will be comparing these ETFs using the nearest common trading date, that is, the nearest date when all ETFs were trading simultaneously on the stock market. In the case of this list, that date is October 27th, 2023, which was the date when the latest among them, QMAX, started trading. The time period I will be using for this comparison is from October 27th, 2023 to August 26th, 2024, which gives us a nice 10-month comparison period, just 2 months short of 1 year. I understand this is not the most ideal comparison time frame, but this is the best way to ensure we are comparing them across similar market conditions. Also, I have added QQQ ETF in this list, which basically just tracks the Nasdaq index. This will help us understand how well the ETFs are doing when compared to the actual index. To compensate for the narrow time frame we are using for this comparison, I will be doing a separate 10 years comparison between TXF and QILD. Both these ETFs are over 10 years old and are probably among the oldest covered call ETFs on the market. With all that highlighted, let us get started with the comparison. So here we have the comparison of the total return for all 7 ETFs we have discussed in this video so far. The first column shows the capital gains or losses, and the second column provides the percentage of return received through the distributions paid out by each ETF in the time frame we are considering. The last column combines the capital gains percentage and the income percentage, giving us the total return of that ETF. The very last row shows the returns of the QQQ ETF, which basically tracks the Nasdaq index, and quite surprisingly, it is the second best performing ETF on this list. There is one ETF which has actually managed to outperform QQQ, and that is TXF, with a total return of 40% during the same time period. But this should not come as a surprise because TXF, along with QMAX and QQQY from Evolve, are all heavily concentrated only on tech companies within the Nasdaq index. If you look at the total return of these three ETFs, they are all very close to the total return of the Nasdaq index. But the only reason why they are able to do this is because tech companies have definitely outperformed other holdings within the Nasdaq index in the past 10 months. But this could also backfire if the same tech companies underperform the rest of the Nasdaq index. In that case, these three ETFs would also heavily underperform not just QQQ, but also other covered call ETFs on this list, which are directly based on the Nasdaq index. In fact, I'm a little bit surprised that QMAX and QQQY from Evolve are marginally underperforming the QQQ ETF despite being focused only on the tech stocks. But now that we know why these ETFs are performing so well, let's take a look at the remaining ETFs that are directly or indirectly linked to the entire NASDAQ index. Among them, the best performer is QQCL with a total return of 27% in the past 10 months. QQCC is not too far behind with a total return of 24%. QQCC and QQCL are basically the same ETF, with the only difference being that QQCL uses a 25% leverage. So the fact that it has a slightly higher return is to be expected. Again, having leverage is a double edged sword. Depending on whether the market is bullish or bearish, it could either outperform or underperform the non leveraged version. Last but not the least, QYLD and QQQY from Defiance have the lowest returns, with QQQY being the worst performer on this list. This again is not exactly surprising since both these ETFs are designed to be income focused ETFs to the point that they even end up sacrificing some of the capital value for ensuring high income. It's a good thing that overall both these ETFs are still giving a positive return, and in absolute terms, even a return of 17% over 10 months is not bad. The only reason why this looks bad is because we are comparing them with other covered call ETFs and the Nasdaq index itself. Also, the reason why QYLD is performing marginally better is because, as I mentioned before, QYLD reinvests a portion of its option income back into the ETF, whereas QQQY simply pays out all of its option income every month. So, between QYLD and QQQY from Defiance, QYLD is only marginally better than QQQY, and at 12%, its distribution rate is also similar to other high yield ETFs. But one thing that works in its favor is that it has been around for more than 10 years. So even though its strategy is somewhat outdated, it has clearly stood the test of time, something that we cannot necessarily say about QQQY from Defiance. Even then, I have a feeling that eventually QILD might end up being phased out by Global X from its ETF portfolio and might get replaced by another fund with a better strategy for yield and capital gains. It seems like the most logical way forward because when you have other ETFs in the market that are providing a similar 12% yield as well as capital gains potential, why would anyone opt for an ETF that only provides option income but sacrifices almost all of the capital upside? So, as more and more investors switch to other ETFs based on Nasdaq index, QYLD might eventually end up being replaced. Nonetheless, the fact that QYLD has been on the market for 10 years and is also outperforming an ultra high yielding ETF like QQQY from Defiance is worth applauding. Along with TXF, it remains one of the oldest ETFs on the market. So it only makes sense to do a 10 years comparison between these two ETFs along with QQQ, the Nasdaq Index ETF, and see how well they have performed during that period. And here we have the 10 years comparison among these three ETFs. Needless to say, QQQ has completely outperformed both TXF and QYLD. It isn't even a contest. I have added a fourth column which shows the year over year return. These numbers might seem quite discouraging for covered call ETFs, but again, it's important not to get overwhelmed by the index's return and think about them in absolute terms. In that case, TXF's almost 11% year over year return is actually quite good. I mean, in the present market condition, if there is an investment that could give me an 11% year over year return for the next 10 years, I would take it. QYLD's 5.3% year over year return seems quite underwhelming until you consider that over the past 10 years, the inflation rate has been around 2 to 3%. So, if you were to put your retirement on this ETF 10 years ago, it would not only have helped you preserve the value of your capital, but also paid out a consistent monthly income throughout that period. Remember, 10 years ago, there weren't that many covered call ETFs to choose from. If you think about it from that perspective, it is not such a bad investment after all. Of course, in recent times, the inflation rate has gone off the roof, and this kind of year over year return would probably underperform the inflation. But I'm willing to cut some slack for QILD because of how long it has been around. I do not, however, wish to end this video on a bleak note for covered call ETFs. So I'm going to do another comparison involving these same ETFs but during a bearish period. The period from November 2021 till November 2022 was quite bearish for the Nasdaq index, during which time it went down by 26%. Let us see how these ETFs performed during that period. As we can see, the TXF actually underperformed the Nasdaq index by 5%. But what do we have here with QILD? It also went down, but only by 17%, as opposed to QQQ's 26% decline. In other words, it outperformed the index by 9% over the 1 year bearish period. The reason why TXF underperforms the index during this bearish period is the same reason why it also outperformed all the other ETFs in the past 10 months. Its heavy concentration on just the tech stocks, as well as its low allocation of portfolio for covered call writing strategy, results in an outperformance during a bullish period, but also an underperformance during a bearish period when compared to the Nasdaq index. QYLD, on the other hand, which is based entirely on the Nasdaq index, ends up outperforming the index because its higher income from covered call writing strategy greatly compensates for the capital loss. Over the past decade, we have seen the Nasdaq index grow significantly, but there was also a period of time known as the lost decade, during which time the Nasdaq index over a stretch of 10 years gave a negative return. From December 1999 to December 2009, the Nasdaq returned a staggering negative 50%. That means if you had invested $10,000 in the Nasdaq index in 1999, it would only be worth $5,000 by 2009. During that decade, covered call ETFs did not exist, so we do not have any actual data for comparison over a prolonged bearish period for these ETFs. But if we take this 1 year comparison during a bearish period as an indicator, I'm quite sure QILD would have outperformed the index by the same margin as the index outperformed QILD during a bullish decade. Given the amount of inflation we are seeing and the fact that the Federal Reserve is not necessarily going to bring down the interest rates anytime sooner, or if they do, it won't be significant enough to have any major impact on the market, we might just be in for another lost decade, or at least a decade where the market simply remains flat. I don't know with absolute certainty how the future is going to be, but if you expect the markets to remain flat or give a negative return over the next decade, then QILD and other covered call ETFs might just end up being better options than the actual index. And with that, we come to the end of this video. As always, make sure to do your own research before making any investment decisions. The information presented in this video simply represents my research and my opinions, and at times I could be wrong. Also, this video took a lot longer than expected to make, and in my defense, all I can say is that I do have a day job, and for a brief period, I also wasn't feeling well, so making this video was put on the sidelines. But I will try to be more consistent with my video uploads moving forward. Let me know in the comments if there are any specific ETFs or stocks you want me to review. Thanks for watching. I will see you guys in the next one.